Good morning. This is Aaron Hall. I'm an attorney for business owners and entrepreneurial companies. We are live here on May 17th, right around 10 a.m. It's a little bit of a cooler morning here in Minnesota, and I am looking forward to chatting with you live for a bit this morning and answering questions. Before I jump into your questions, there is, of course, a disclaimer I need to offer, and that is this is educational content. I'm not giving legal advice to you. And what do I mean by that? Well, if as an attorney, when I work with clients, I analyze their circumstances, I ask follow up questions, I make sure I fully understand the circumstances of their situation, and then I give advice tailored to that. So it's highly customized advice. Whereas today, we're talking about general legal principles, education. So we're not digging into all the exceptions. And if you're not in Minnesota, I don't know the law in your state. I don't know uh, the nuances of issues that may be relevant to your circumstances. And so I'm going to stick today with general legal principles that typically apply to everywhere in the United States, and in fact, many other common law countries or countries with similar legal systems. But just keep in mind, uh, the purpose of this is education to inform you on issues to discuss with your attorney in your state, not to act on in your particular situation. So let me be really clear. You should always contact an attorney in your state before acting on information you find on the internet, including something like this. Now, if you submit a question, please keep in mind this is public. I think it's obvious. You're putting it on YouTube. It's going to remain on YouTube. It's going to be available to the public. It's going to be available to others down the road. So please don't put confidential information. Don't put too much personal information. Uh, General academic questions are fantastic. And that's what I'll be tackling today. We have a lot of them that have already come in, and I do my best to sanitize the questions so that they can be helpful educational topics to discuss and to empower you with education. But we don't want to get into the details of specific situations. That again is why it's helpful to consult with an attorney who's representing you in the protection of the attorney client privilege and the confidential nature of that discussion. You get far more value from an attorney you consult with than just general education. That said, it is my hope that through the videos on this YouTube channel, you will be empowered with knowledge so that you can avoid problems and know exactly what legal issues to look at with your attorney. All right, you're here today because you either subscribe to this YouTube channel, and thank you if you do that. I'm glad to have you subscribe so you get notified of upcoming videos. Or maybe you subscribed to our newsletter, which really is exclusive videos. You get a free PDF with the 7 most common legal mistakes made by new businesses. And then you get videos explaining those and helping you identify how to avoid those problems in your companies. If you don't have that yet, you're welcome to get it. You can get it at aaronhall.com/free. So AARONHALL.com/FREE. Maybe you're on another media platform and we have a presence out there as well. But thanks for coming today. If you don't have a YouTube account, which is just a Google account, and you still want to submit a question, you're welcome to do that. And you can do so by looking in the description down below. You'll see a little link to submit your questions. So that allows you to even submit them anonymously if you want. Okay, so I'll be taking questions as we go today. Because you are attending live, your questions will be addressed first. But I also have a variety of questions that have come in on other comments, on videos, and submitted otherwise. And so we'll be working through those as well. Okay, it is time to get into the first question. How do you use a DBA in your business? So, if you are thinking about using a DBA, it's because you probably have an LLC or a corporation, or you're thinking about getting one, and you heard about a DBA and you've heard that it can be a really great option, but you maybe are a little bit hazy on how it works or what it is. Let's talk about that today. And my hope is that when we get done with this little response, you will have a clear understanding of what a DBA is, how it's used, and then we have a few follow up questions about DBAs. So, what is a DBA? Well, it stands for doing business as. It's sometimes called an assumed name. There are some other names, different states have different names for it, but DBA just means nickname or alias. So, for example, I am Aaron Hall, but I might go by other names. Maybe it is dad when my daughters refer to me. But so it's just a name. It's not an entity. I'm not another person because I'm a dad. It's just a nickname. So think of DBA as a nickname. So let me give you some context. Let's say you have an LLC and it's called Bob's Candy Supplies LLC. But then let's say Bob starts providing fudge. Uh, and Bob doesn't want to have it just be Bob's Candy Supplies LLC. He wants to also have it, the company be known as Bob's Fudge. That LLC can have multiple names or nicknames. That's what a DBA is. It's just nicknames for the entity. And I'm hitting really hard on this because a lot of times when people have confusion around DBA, they think of a DBA as a separate entity. It's not. Just like I'm not a separate person just because I go by different nicknames, your LLC is not a separate company just because it goes by different nicknames or DBAs. So a DBA is a nickname, it's an alias, it's nothing more. All right, so I now have the next question. Somebody submitted this. I'm very close to starting my business. I was looking to register my LLC as a very broad name and create one or two DBAs under the LLC to specify each business niche I'll be starting. When getting a bank loan, do I fill out information for both the LLC and DBA? All right, the short answer is yes, you'll disclose both of those to the bank, but it's only one LLC and a nickname. Here's how that works. You walk into the bank and you say, "Hi, could I meet with a business banker? I'm interested in a bank loan." And the teller at the front desk says, "Sure, let me see if somebody's available." So the teller at the front counter finds a business banker who you can meet with. You then typically sit down and they say, "Hey, tell me about your business. Tell me a little about you." And you small talk a little bit. And then let's say you decide, "Hey, I'm interested in applying for a bank loan." The banker is going to explain some of the different loans that are available to you. One of those would be an SBA loan or a Small Business Administration loan, which means it's backed by the federal government. If you default and don't pay the loan, the federal government will cover part of that. And you say, "Hey, that sounds great. I'd love to get started." And they say, "Great, here's an application. Fill out this information about your business." You're going to fill out all the information about your LLC. And then it will also, the application will probably ask, does the LLC have any other names? That would include DBAs or assumed names. And that's where you would put any other DBA that it has. So just to be really clear, you're filling out the application for the LLC and you're identifying any other names it goes by. But you're not filling out a separate application for the DBA because that would involve a lot of redundancies. The DBA is just a nickname for the LLC. All right, next question. Can a DBA get a bank loan? An LLC can get a bank loan, and a corporation can get a bank loan. And either one of those can have a DBA, which is essentially just a nickname. So, yes, a DBA can get a bank loan because a DBA is just a nickname for a business entity like an LLC or a corporation. But can the DBA go get a loan as a separate entity? No. A DBA is just a nickname for your LLC or corporation. So it's really the LLC or corporation getting the loan, and the DBA is just a nickname or alternative name for the LLC or corporation. And by the way, whenever you disclose to the IRS or to a lender or like a bank, a DBA, you're typically telling them also the entity registered in association with the DBA. In other words, if you have an LLC, you're getting an EIN for the LLC, even though you disclose to the IRS that it has a DBA. All right, let's move on to the next question. Should you create a second LLC for your second business? So here's the setup. You have one LLC for one business, and now you are starting a new business, and you're thinking, should I create another LLC for that new business? Or should I use the LLC I have for my existing business? Most of the time, people will create a separate LLC for a totally unrelated business. And that's because you may want to sell one of the businesses later and you want them separate. You may want to divide liability. So if one business gets sued, the other one isn't at risk. You might want to get a bank loan for one of the businesses and not the other. Or maybe you would have multiple owners in one of the businesses, but you would be the sole owner in the other business. So there are a lot of reasons why you may want to get a second LLC. But what are the reasons you might want to keep everything in a single LLC? Well, a second LLC costs more to set up. If you have payroll, you're going to pay a payroll company for a separate payroll. You'll have separate books and financial records. You might be paying a separate QuickBooks fee. You might have separate tax returns at the end of the year for that second business, depending on how you do this. You will probably need separate insurance policies, separate state tax IDs, separate contracts and legal documents. So in order to for the government and other parties to respect your two LLCs as separate from each other, they have to be treated separately. And that means redundancy or duplication of a lot of the steps required to run an LLC. So a lot of times business owners decide, I'm going to keep it all in one LLC to begin with because I don't want all the hassle and expense of managing two LLCs. And then later, I may spin it off or separate part of the business into a new LLC. So, for example, you might think of it as two departments within the same business. And that one department might eventually spin off into a separate LLC. So, should you create a separate LLC for your second business? It really depends on the circumstances. If it's a large business, I would say yes, create a separate LLC. If it's really small and you're not quite sure you're going to do it, go ahead and keep it in the same LLC. Of course, either way, it always makes sense to talk with an attorney and a CPA to kind of walk you through the pros and cons for your specific circumstances. All right, let's take a look at the next question. My wife and I started an LLC. Can we pay ourselves without starting an entire payroll system? We've heard of the owner draws, but that really doesn't help when we need to prove income amounts. So I think I would rephrase the question like this. When an LLC is owned by a husband and wife, how does the LLC pay them without starting a formal payroll system? So the short answer is you can simply write yourself a check from the LLC to your personal checking account. So it might say, so the check would be from the LLC and say to Mary Smith, $1,000. And then in the memo line, you could put profit distribution. Let's break this apart though, because there are a lot of different pieces here. So first, this whole idea of profit distribution. When an LLC generates profits, the owner is entitled to those profits. So the profits can be sent to the owner simply by writing a check. You might say, can I do a bank account to bank account transfer? Sure, that's not a problem. When that $1,000 comes into Mary's account, it's her money. She's been paid it. It's a profit distribution, what you might know of as a dividend when it relates to a corporation. And Mary can do with it whatever she wants. Now that's personal money. But I would caution you that Mary is going to owe significant taxes on that. She's going to owe both income tax because it was income to her. In legal terms, it's called ordinary income. She's also going to owe self-employment tax, which is about 15%. What is self-employment tax, you might be asking? When a company pays an employee, the employee looks on their pay stub and they see that about 7.5% of their wages are set aside or held. And then what you may not know is the company also pays about 7.5% to the government. And we call those two amounts payroll tax. So the employee's portion is 7.5% and the employer's portion is 7.5%, roughly. So a total of 15%. We call that payroll tax. The employer sends that to the government. Well, as you know, when you're working for your own LLC, you're both the employer and the employee. So you have to pay that full 15%. But the government uses a little different term for it. Instead of calling it payroll tax, they call it self-employment tax. It's essentially the same thing. So just keep in mind that whenever you pay yourself, 15% is coming out for self-employment tax. Then you have state income tax and federal income tax. So as a rule of thumb, if you want to be safe, set aside half of the money that your LLC pays you for taxes. So if you get $1,000, set aside 500 of it for taxes. You can put that in a separate account, or you can just save it until the end of the year. If you have questions on this, CPAs are the most knowledgeable in this area, and they can guide you on the best way to handle this for your circumstances. So, can you do all this without a payroll system? Absolutely. You don't need to set up regular payroll for a husband and wife to own a business themselves and pay themselves. I would encourage you to consider setting up an S corporation. so that you can save money on payroll tax, I have a separate video on that. I would also encourage you to consider having the business owned by one of you instead of both of you. And here's why. Generally, the an LLC is considered a marital asset if people get divorced. And the vast majority of the times, that LLC is split 50-50, or one person buys the other out in case of a divorce. So you don't really have to be worried about divorce when it comes to joint ownership of a business. In other words, there isn't a benefit in divorce by having the LLC owned by two people. And there generally isn't any other benefit by having the LLC owned by two people. It's better to have it owned by one person because there are less taxes to deal with at the end of the year. Now, they might still be employees of the company, but having a single owner usually results in less legal work and less tax preparation expenses at the end of the year. So I almost always recommend that my clients have their LLC owned by either the husband or the wife. Now, you might say, how do you decide which one? First, I ask, is there a benefit to being a woman owned business? Like, are you seeking government contracts or some other government program that would benefit a woman owned business? Then it should be owned by the wife. Otherwise, I say, have the business owned by whoever is actually signing most of the documents and running the business, kind of whoever is serving as the president. That might be the husband, might be the wife. But it makes sense to just have the owner be the same one as the person who's running the company, because then you don't have to get into issues involving who makes a decision, the president or the owner. If you have any follow-up questions on that, feel free to submit them. But in the meantime, I will move on with the next question. Do content creators need copyrights, trademarks, or patents? Let's break that into three questions. Do content creators need copyrights? The short answer is yes, but you don't necessarily need to spend money on it. And if you do spend money, you don't have to spend much. Here's why. When you are a content creator, for example, maybe you create content on Instagram, videos on TikTok, videos on YouTube, etc. By creating content, you automatically get a copyright in that content. Merely the creation of content creates a copyright owned by the owner, the artist, the one who created it. Now, if you're an employee working for an employer, the general rule is the employer owns the copyright. But let's assume you're creating this on your own. By creating content, you have established a copyright, or a common law copyright. It's not a registered copyright, though. Why? Because you didn't go file and register for copyright protection. Why does that matter? Because when you register for a copyright, you get a lot of important additional rights and protections. So the good news is, when you create content, you automatically get a copyright in that content. Nobody else can take that copyright from you unless you give it to them. But by registering the copyright, you get rights such as being able to sue somebody for infringing your copyright, being able to prevent somebody from importing infringing goods into the country, and other important rights like recovering attorney's fees if you sue somebody for infringing your copyright. So people then often ask, should content creators register a copyright for everything they create? Usually that doesn't make financial sense. In other words, It would be pretty expensive to register a copyright for every single TikTok video you create, and every Instagram post, and every YouTube video. Usually, content creators rely on the common law copyright protection that arises when they create content. But as they grow in popularity, or as their business generates more money, they may decide to register a copyright in the really valuable work they've created. So, valuable video content, for example. Do you need a lawyer for that? Generally, no. I regularly encourage my clients to try to do the copyright registration on their own because you pay a small filing fee. It's a fairly straightforward process. The Copyright Office isn't carefully scrutinizing what you've submitted, it just gets stored on file. Trademark is very different, though. Let's talk about that. Do content creators need trademark protection? Yes. The good news is you get a trademark just by using your mark or your slogan or your name in the sale of goods or services. And we're talking about significant goods or services, which are called commerce. Advertising often is included with that. So let's break that down a little bit. First off, what is a copyright? Or I'm sorry, what is a trademark? I visualize cows. Yep, I'm talking about animals out on a pasture. And if you look at that cow, you want to know who's the owner of the cow. Well, if the cow has a brand on it, then you know it's the owner of that brand owns that cow. If the cow has no brand on it, you don't know who owns the cow. So, whatever logo or name is on the cow, you could call that its brand or its trademark. Now, it's not necessarily registered anywhere, but simply by using a brand on a cow, you've acquired common law trademark rights where that cow is, assuming that cow is in commerce. Let's talk about that. What is commerce? Commerce is the sale, excuse me, commerce is a sale or significant advertising of any goods or services in a way that affects commerce in multiple states. So, for example, if you just sold a piece of bubble gum to somebody who lives in your home, you are not acquiring substantial, or you're not engaging in substantial commerce. That's not likely to establish common law trademark rights. And under US trademark law, which applies to any sort of commerce affecting multiple states or from one state to another, then you are subject to the Lanham Act and US copyright statutes. But simply by selling something doesn't give you nationwide trademark protection. It only gives you common law protection in a particular county. So let's say your cows were being sold from your location in Hennepin County to a buyer in Ramsey County. This is all in the Minneapolis, Minnesota area. Most likely, through those significant transactions, you are acquiring common law trademark rights for the brand on the cow in both Hennepin County and Ramsey County, but not Iowa, not New York, not California. If you want nationwide trademark rights, you need to file for a federal trademark registration. So, Going back to the original question, do creators need trademarks? The answer is yes. Whenever you use a brand or a mark or a logo or a slogan or a phrase associated with your goods and services, and as long as that is unique to you and somebody's not already using it first, you are acquiring common law trademark rights. I'm assuming this is associated with some sort of transactions or goods or services. For example, if you're creating videos where there's some sort of business component ultimately, that usually satisfies the requirement. So if you have a slogan that you use every time in your videos, and there is some sort of ultimate transaction where you can make money on those, maybe it's through ads on your videos, paid out by YouTube, maybe it's some other source, you would most likely be acquiring common law trademark rights in that slogan. But if you would like to get nationwide protection, that's where it makes sense to do a registered trademark. The cost to do a registered trademark is usually between $1,200 and $1,500 per mark, but there can be bulk discounts. And usually you need to use an attorney for that to get it done right. Unlike copyright law, where when you file a copyright registration, there is no strict scrutiny by the Copyright Office. In a trademark office, when you file a trademark registration application, an attorney will closely scrutinize your application. And it is quite common for the trademark office to reject applications or require changes because there were some sort of errors made. Also, even if they allow it through, your application is only as strong as its accuracy when you wrote it up. I've seen many times where people don't do it right. They have some sort of legal uh, imperfection or error that results in uh, eroding the value of the trademark to the point where sometimes it's worthless. So I always recommend people work with an attorney for trademark registration. I always recommend clients try to do copyright registration on their own, especially if it's not a significant work. A movie's a different story, but if it's a poem or an Instagram post or a short video without significant revenue tied to it, uh, often you can just handle that copyright registration on your own. Do content creators need patents? Usually, no. Most of the time, content creators do not need a patent because a patent protects processes, formulas, and designs that involve utility. Contrast utility, like practical benefits, with art. Art is in the realm of copyright. And so they're very different there. So usually content creators do not need patents. Okay, let's move on to the next question. Feel free to add your questions in the comments, or if you have another question to add and you don't have a Google account, you can click the link in the description below and submit a question using a simple online form. Okay, this is an interesting question. Can a real estate trust hide the owner of property? Yes, it can. Real estate trusts are regularly used by famous people. I have a number of clients who are, you might consider celebrities or famous people, and they don't want people to know who owns their real estate. For example, if they buy a cabin in Wisconsin on a lake, they may not want in the public records their name. For example, imagine if you saw Tom Cruise or is the owner of a cabin and you know it's a beautiful cabin, you go, oh, wow, I bet that's the actor Tom Cruise. Usually, celebrities don't want people to know uh, who owns the property. They're looking for some privacy. They also don't want to be sued personally for anything that happens on the property. Celebrities know that they are often a target for lawsuits. And so the last thing they want is their name on public records as being the owner of real estate. So what do? They set up a trust. What is a trust? A trust is a special type of contract where that's recognized by state statutes. And the contract essentially says this property is held in kind of a fictional entity called a trust. So the trust gets a name and it's being managed by a person, that's the trustee, and it's being managed for the benefit of a person. That one's called the beneficiary. By setting up a trust, you can just create essentially a legal entity to own real estate. And that trust generally does not have to be registered anywhere. Unlike an LLC or a corporation where you register the business for it to be established under law, a trust is generally not registered. There are millions of trusts that the government doesn't know about because it just exists on paper. And the only time it matters is if somebody dies associated with the trust or the trust decides to buy property that has a registered owner or registered title. So, how does this work? Let's say that I am representing a celebrity, and the celebrity says, hey, I am tired of running into problems and people knowing where I live, and I don't want. Um, I've had some stalkers. I've had some paparazzi. I really want some privacy. Is there a way to protect my privacy as it relates to my current home? And what I would tell that celebrity is, unfortunately, your name is already in the real estate property records. It's already public information. That information is often online. Unfortunately, there's nothing you can do about the current real estate. But if you buy real estate in the future, there is something you can do. You can set up a real estate trust. By the way, this is really just a trust that owns real estate. It doesn't necessarily need to be there isn't necessarily a category called real estate trusts. There are trusts that have real estate in them, so we call them real estate trusts. So we could set up a trust for this celebrity, and then the trust can buy the next uh, property. Maybe it's a cabin, maybe it's a home, and that we can give the trust a name that would not cause suspicion with the paparazzi. Then nobody will know who owns the property. It will just be the trust. They'll see the trust name on there. That's it. Now, often the name of the person managing the trust, the trustee, can get listed, and so you can hire somebody or a bank trust office to handle that for you as well. That way, you get a little even more privacy. You get even a little bit more privacy. Now, will the IRS know? Yeah, the IRS needs to know who is associated with the trust, but that's confidential. If you have a mortgage on the property, will the bank or lender know? Yeah, the bank or lender needs to know who is personally guaranteeing the loan. Banks don't lend money to trusts without a personal guarantee, unless the trust happens to have a significant amount of assets, which typically then the bank will want used as collateral in order to grant a mortgage on the property. So let's circle back. Can a real estate trust hide the owner of property? In other words, can you use a trust to keep confidential who the owner is of real estate? You absolutely can. And it's regularly done. So if you're looking for that sort of if you're looking for that sort of privacy, a trust is a great way to purchase real estate. Does passive income have legal risks? It does. Let's talk about passive income a little bit. Passive income is a term that gets a lot of hype in get rich quick schemes, on YouTube videos, on social media. We all love the idea of not having to earn income, but instead being able to get it passively. I mean, wow, wouldn't that be fantastic to just have money rolling in and we don't have to work for it? Well, here's the catch with passive income. Passive income happens from two things. And in my experience, only two things. It's either an investment like real estate or stocks or bonds or a loan that you're getting some sort of interest or dividend or payment from, or it's some sort of intellectual property that you put effort into or somebody put effort into, and now you are getting royalties or residuals or some sort of ongoing stream of money. I'll give you an example. Let's say you create an awesome YouTube video, and now that video starts generating views and it's monetized on YouTube. So now there are a bunch of ads being run on your video, and YouTube starts sharing that money with you. Well, if that video continues to generate views over the next 10 years, you will continue to get ad revenue from those views for the next 10 years. Usually, when you create something, there needs to be some sort of ongoing maintenance of that thing in order to keep the money coming in. For example, if an author writes a book, and let's say that book does well, usually sales dwindle off over time. And the author needs to write another book and do more publicity and do social media. And by the author having that ongoing activity, it continues to generate money from the book. A lot of times when people online are talking about passive income opportunities, they are not giving full attention to the fact that first, you have to create something in the beginning, which takes a lot of work, and you're not getting paid for that. The income is coming over time. So there's that upfront investment in creating something. And then, second, usually people who talk about passive income fail to remind you about how much maintenance is required to keep the income coming in. Even if you have money invested in the market, you generally need to manage that or pay somebody to manage it on your behalf. Now, I have worked with people who inherited trust funds. And so essentially, there is money earned by somebody else in their family that continues to get paid out to them. That is passive income. But keep in mind, it was earned by somebody at some point. I have never ever seen passive income that didn't come from either some sort of asset like money or real estate or something that was all first earned and then generated a stream of income, or intellectual property that was created and then generated a stream of income. So, in my mind, you might even argue there is no such thing as passive income. There is a stream of income that you can get when you do a lot of work for free and have good success, or you build up a lot of wealth through hard work, and then you invest that and have a stream of income. But I think it might be more fair to say um, income can be passive once you have done a substantial investment, either building assets or intellectual property that creates a stream of income. But keep in mind that involves a lot of work up front and no guarantee of payout. It really depends on the success of your investment or your intellectual property. And you might be saying, what am I talking about with intellectual property? Movies, songs, music, uh, paintings, books, audiobooks, images, photography, uh, really a play, anything with creative value that people will pay for involves a lot of investment in creating it up front, and then the compensation ultimately comes later. Go ahead and call it passive income if you want, but it sure wasn't passive in the beginning. You're quite active in creating that. So that answers the question of what is passive income. Let's now talk about, does passive income have legal risks? Yes, it does, because what happens if whoever you're entrusting to manage that asset that is generating the income doesn't come through for you? What if they breach the agreement? What if somebody infringes your intellectual property rights? So let's say, for example, you write a song, and let's say it's just a timeless masterpiece. This song gets played every year at some sort of event, and you have an opportunity to get royalties whenever that song is played. Well, you're going to have to pay somebody to monitor when the song is played, send cease and desist letters on your behalf when they've infringed your rights, and send demands for payment when you're not getting paid for the use of your song. So typically, you're going to hire somebody who will manage your music rights. And that there are big companies throughout the United States that handle that. So there's going to be some sort of fee. Other people, though, may not have a full industry built around managing your intellectual property rights. So you might need to manage them yourself or occasionally Google and see if somebody is infringing your rights. You might need to have an attorney on file who can send cease and desist letters from time to time. Also, if you have intellectual property that you're letting other people use in exchange for money, that's called a license. License just means permission. You're giving somebody permission or a license to use your intellectual property. And you typically do that in exchange for an agreement to get paid. So you need to have a license written up. It's a legal document that says, I'm giving you permission to use this, and here's how much you have to pay me. And then there's a process of enforcing that. So there are a lot of important parts to protect your passive income. And usually it involves having an attorney involved in licensing, copyright, trademark, and contracts to ensure that whatever is generating your passive income is protected from an intellectual property standpoint, and you are properly getting paid in accordance with the agreements that you've set up. Okay, we have time for a couple more questions here. Feel free to submit a question. We still have time if you'd like to get a question in today and you're watching live. What is the difference between a revocable trust and irrevocable trust? Well, let's break this apart. A trust is essentially a fictional legal entity that is operated by somebody for the benefit of somebody. It's not registered like an LLC or a corporation, but it is an entity under the law. And there are certain rules, and somebody's appointed as the manager. We call him a trustee. And somebody gets the benefit of the trust. We call him beneficiary. So what is a revocable trust? That's a trust that can be set up by someone. We call them the grantor. and it can be changed by that same person. So, for example, if I set up a trust and it says I have the right to change it at any time and it's written right in there, that's what's called revocable. I can change it, I can revoke it, I can do whatever I want. Irrevocable means you can't change it. So if I set up an irrevocable trust, that means once it's there, I can't change it. It's stuck for life. Most people, for estate planning purposes, set up a revocable trust because they want the right to change it over time. As they get older and as their circumstances change or as their relationships change, they might want to change who's managing the trust and what happens with their assets in the trust. But there are definitely circumstances where it makes sense to have an irrevocable trust. That's, for example, where the law requires it. Another example is where you want to protect whatever assets are in there, that even somebody who steps into your own shoes could not change the trust because you don't have the authority to change the trust. So somebody in your own shoes can't change the trust. Irrevocable trusts are often used to protect assets from future creditors who might sue you, and they might be able to take everything you own, but they can't take what you put in an irrevocable trust. So, what's the difference between revocable trust and irrevocable trust? A revocable trust can be changed by you, usually at any time, and it can be wiped out. An irrevocable trust cannot be changed by you, which means once you put it in place, it's locked in, it's permanent. Next question. Should rental property be in an LLC? This is a contentious issue. This is an issue that lawyers will debate and they feel quite strongly about their position. Here are the two sides. On one side, lawyers say, put your LLC in an, I'm sorry, on one side, lawyers say, put your LLC, I'm sorry, I keep saying that wrong. On one side, lawyers say, put your rental property in an LLC. So that way, if there's any lawsuit related to the rental property, they can sue your LLC, but they can't sue you. That protects your personal assets. That's very reasonable. And that's a very common approach. But there's also a reasonable argument not to put your rental property in an LLC. Let's say you just have one rental property. And let's say you get $1 million insurance policy on that property. So if there's any lawsuit related to some sort of injury that happens on the property, the insurance policy would cover you. Let's say you also hire a management company and that management company finds tenants for your rental property and drafts the lease, and the tenants or renters sign the lease with the management company. Well, if there's a lawsuit for breach of contract because the management company did something wrong, the tenant will sue the management company. So as you can see in this scenario, if there's a lawsuit involving breach of contract, it's the management company that gets sued. If there's a lawsuit involving an injury on the property, your insurance company covers it. Why do you need an LLC? In other words, an LLC may be creating additional legal work and expense without some significant benefit for you in that scenario. Now, if you're not going to use a management company, I'd recommend having an LLC because you want that LLC to be the management company so it gets sued if there's some sort of breach of the lease. And I think it's always a good idea to have some insurance on the property. It's usually very inexpensive, like a few $100s per year. And that just gives you the peace of mind to know that your business investment is safe. So, do you need an LLC? That's probably a question for you and your attorney and perhaps CPA to resolve. But uh, at least the general considerations I've mentioned today can inform you on items to discuss when you ask your attorney about whether you need an LLC for your rental property. Also, keep in mind, some attorneys, unfortunately, like to make money, and they might be willing to sell you an LLC by arguing it gives you the most protection. And it's true, it does. But I'm always thinking with my clients, do I need the most protection, or should I balance the expense versus the risk? And if there's not a significant risk, then I say it's not worth spending a lot of money on the legal fees. Now, is an LLC expensive? No, it's not that much, but it's something. And it comes out of the proceeds of the rental property. So if there's one property and they have a management company and they have a insurance policy in place, I usually say you may not need an LLC. But if you really want to be cautious or you have significant assets or you don't have a management company, then it probably makes sense to have an LLC, own your rental property. Okay, we are getting close to the end here. Let's see if there are any final questions that we should tackle today. Like we have one more here. This will be our final question. If you own an S corporation, how does it pay you? An S corporation can pay you in two ways. First, if it doesn't have enough money to pay you, you don't get paid because you're the owner. But if it has enough money to pay you, first it needs to pay you wages, and you are going to pay payroll tax on that and also income tax on that. And those wages need to be a reasonable wage, fair market value is what the IRS says, for the services that you are providing as an employee in the company. But let's say the business generates a lot more profits than what it's paying you as an employee. Then your S corporation can pay you a profit distribution or dividend. Essentially, you are going to get those profits paid to you free of payroll tax. You'll still have to pay income tax for state and federal, and that's considered ordinary income. It's not capital gains. But at least in an S corporation, you can avoid payroll tax on the portion of profits you get beyond your wage amount. You might say to yourself, can I pay myself $1 in wages? That way the rest of it comes free of payroll tax? Unfortunately, no. The IRS says you have to pay yourself a reasonable fair market wage for the job that you're doing. So you can hop on Indeed and see what is the going rate for something like this. So in an S Corp, how do you pay yourself? Well, assuming there's money, first you'll pay yourself in wages, and then you may write yourself a check for profit distributions. And you don't have to do that every week, every 2 weeks, or every month. You can just do it from time to time as the financials permit. All right, that does it for today. Thank you for joining for the live session. I expect we'll do more of these, but I'd love to know if you find this helpful, if you'd like us to do more live sessions. And by the way, if you have other questions, feel free to add them in the comments section below. We will grab those and use those for future live sessions. You can also submit questions by email or using the form in the description below. I'm Aaron Hall, an attorney for business owners and entrepreneurial companies. This has been an educational broadcast. As always, all these issues I encourage you to use as topics to discuss with your attorney, not as a replacement for an attorney. This is educational information to empower you to avoid problems, establish a great company, and hopefully have a better life. You can find out more about me at aaronhall.com.